This video is about accounts in the general ledger. The general ledger is a record containing all accounts used by the company. Account is a record of increases and decreases in a specific asset, liability, equity, revenue, or expense. You can think about accounts in the general ledger like file cabinets. So in this drawer, we keep all of our asset accounts. In this drawer, we keep all of our liability accounts. In this drawer, we keep all of our equity accounts. Now, if we wanted to pull out an account, it looks like a card, let's say. And if you pull the cash account card out, you'll see all of the money coming in, all the money going out, and then the balance of that account, how much cash you have. The accounts are organized by the accounting equation. So all the assets will be grouped together in the asset drawer, and then all the liabilities will be grouped together in the liability drawer, and all of the equity accounts will be grouped in the equity drawer. Let's talk about assets. Now, we know that assets are items owned. Well, the first asset would be cash. Well, we own that cash, don't we? Yes. So cash is an asset. We also have this thing called accounts receivable. That's money that is owed to you. Let's say that you're in the lawn business and you mow this guy's lawn. And when you're done with the job, you say, that will be $30, please. And he'll say to you, I'll pay you later. Well, you have the right to receive that money, right? You own that right to receive the money. So that would be put under accounts receivable. Matter of fact, when you see the word receivable, you know it's an asset. Just remember that. If you see receivable, that's an asset. Next, we have this notes receivable. Well, what's the difference between accounts receivable and notes receivable? Well, accounts receivable is like on the honor system. You know, you set up credit terms with your customers, and you just kind of accept the money to your agreement. Usually, you'll get paid within 30 days. That's pretty common. A notes receivable, that's a right to receive money, and you own that right to receive money, but that's in writing. You have the person that owes you money sign a promissory note. And it says, I promise to pay you this amount of money with interest on this date. It has the force of law. And so if it's a larger amount of money that he owes you, it'd be really good to have him sign a note. The next asset are prepaid accounts. Now, the best example would be like when you buy an insurance policy. Well, you own that policy, don't you? Yeah, so that policy is an asset. And because that policy, that insurance policy is going to benefit you in the future, you book it as an asset. So that's why it's called prepaid insurance. You pay it up front, but it's going to benefit you for months to come. My insurance policy for my car is usually, I pay them every 6 months. Now, another example of a prepaid account would be prepaid rent. Let's say that you pay your landlord for 3 months in advance. Okay, so that cost is going to benefit you for the next 3 months. So you're going to book that as prepaid rent. These others are pretty easy. Supplies like paper and if you're in office, paper, pens and pencils, that type of thing. You own those. Of course, you own the equipment, you own a building, and you'll own land. So that's pretty easy. Let's move on to liabilities. Now, when you see the word payable, you know that's a liability. So what's accounts payable? That's money that you owe in the future, right? A good example of this would be you're a building contractor and you have an account with Ace Hardware. You go in the store, you buy a hammer, and you say, hey, man, put it on my account. You walk out, and then they're going to bill you for it. And then 30 days later, you pay your bill. Now, just like before, if you have a notes payable, that means you signed a promissory note saying, I promise to pay you this amount of money plus interest on this date. And that has the force of law. Okay, the next one is unearned revenue. Now, this one always gave me fits when I was in my accounting 4A class decades ago, because I kept seeing revenue. Well, hey, if it's revenue, it's not a liability. It's you earned it. It's in the revenue. No, you have to hang on this part, unearned. When you see the word unearned, that's a liability. Well, what is unearned revenue? Let's say that you own Tower Theater and you are going to provide a concert series, like a smooth jazz concert series, and you're going to sell season tickets. So your patrons they're going to pay you all this money for the entire season. So now you have their money, but you haven't done anything for it yet. You haven't provided them any concerts. So while you're hanging on to this money and you haven't done anything for it yet, you owe it to them. So if you never perform the concerts, you have to give it back. And then, of course, you're going to reduce that liability as you perform the concerts. So in my face-to-face class, I kind of train my students to hear these words, and then they think of unearned revenue. When you hear cash advance, you think unearned revenue. Let's try it. Cash advance, unearned revenue. Cash advance, unearned revenue, right? It's unearned because you're receiving the money in advance, but you haven't done anything for it yet. And until you do, you owe it. The final one here is accrued liabilities. A good example of that would be wages, okay? So your employees work for you, and so you incurred the wages expense, right? But let's say that you haven't paid them yet. Well, don't you owe it to them? Yeah, so you have to, you'll recognize the wage expense, but you'll also have to recognize wages payable because you owe them. Another good example would be interest. Let's say that, you incur some interest expense, but you haven't paid it yet. Well, you owe it, right? Well, you have to accrue that interest, and you'll book the interest as interest payable because you haven't paid it yet. You owe it. And finally, we have the equity accounts. Now, I told you before that equity overall, there's just two accounts, common stock and retained earnings. That's what you see in the balance sheet, right? Common stock and retained earnings. Well, you see common stock, and that represents the owner's ownership interest in the company. So let's say that the owner invested $10,000 in the business. Well, cash goes up, assets go up, and who has claims to that cash? Well, the owner does, and that's evidenced through his common stock. Now, where's retained earnings? Well, these three items kind of represent retained earnings. Remember the formula for your retained earnings statement? Beginning retained earnings plus net income minus dividends equals ending retained earnings, okay? Plus, so you start with beginning retained earnings plus net income. Well, here you go, revenues minus expenses. The net of these would be your net income. And then minus dividends, and here you go, minus the dividends. So these three items kind of represents your retained earnings. Now, as I told you in an earlier presentation, that these four components represent equity, right? So common stock is good. It increases equity, right? When the owner invests into the business, assets will go up and his ownership interest will go up. Likewise, revenues are good. They increase equity. That's the amounts that you earn. Expenses are bad. They decrease equity, right? That's how I remember it. I mean, it sounds really kind of crazy, but you'll remember it that way. And then finally, dividends. Now, dividends is money that you take out as a distribution of profits. All the past profits in retained earnings belongs to the owners. And at a certain point, they want to take that money out of the business because it's their money to begin with. And we do that through dividends. So dividends decreases retained earnings, which would decrease equity. Okay, now let's try to classify each of these as an asset, liability, or equity. And I'm going to give you these hints. When you see the word prepaid, it's always an asset. When you see the word receivable, it's always an asset. When you see the word payable, it's always a liability. And unearned will always be a liability. Let's try this out. Prepaid rent. Well, prepaid, it's an asset. Now, we know that common stock is equity. How about notes receivable? It says receivable, so that means it's an asset. How about this one? Accounts payable. If you see the word payable, it's a liability. How about this one? Accounts receivable. Well, if it's receivable, it's an asset. Equipment, well, we own the equipment, so that's an asset. Interest payable. You hear the word payable, that's a liability. How about this one? Unearned revenue. When you hear the word unearned, that's a liability. Land, well, you own the land, that's an asset. And prepaid insurance. Okay, when you see the word prepaid, it's an asset. You could have prepaid insurance, prepaid rent. All those are going to be assets. Good. Now let's take a look inside the ledger. And the general ledger is a record containing all the accounts used by the company. So collectively, these drawers are the general ledger. And inside the general ledger, you have all these accounts, which I like to think of them as cards. Well, if we pull this cash card, this is what we'll see. Now, in my first video of chapter 2, I talked about the general ledger as being a set of glorified T accounts. Well, this is what I meant by that. Now, you don't even know what a debit and credit is, but right now, you see that T account here? Every account's going to have one of those. And there's going to be a debit side and a credit side. And in another video, I'm going to teach you what all that means. But right now, just kind of go with me. When you post your journal entry to the cash account in the journal ledger, if it's a cash coming in, you're going to debit $15,000. You're going to put that increase in cash on the debit side. Now, that means now you have a balance of $15,000 in cash. Now, when we post from the journal on October 27th, we credited our cash, right, by $700. That means that's cash going out. So debit means cash coming in, credit means cash going out. Right now, we have a balance of $14,300. So I call this a glorified T account because it not only has the T account, but it's got other information like a running balance. Now check this number out. Every account is going to have a number, and it's organized in a systematic way. In our example here, if you see an account that's in the 100s, then you know it's an asset. Okay, so right now this cash account is number 101. Now, if you want to see all of them in one place, let's look at the chart of accounts. And the chart of accounts is simply a list of all the accounts and includes an identifying number for each account. So remember I told you that if it's in the 100s, it's got to be cash. Well, check this out. Cash, accounts receivable, supplies, prepaid insurance, and equipment, they're all in the 100s. Now, when you get to liabilities, it goes to 200. That's where you have accounts payable and unearned consulting revenue. Then the 300s are for equity. The 400s would be for revenue. And what's interesting is they just skip 500s and they go right to 600. But at least it's systematic, right? Now, you may ask yourself, well, why are they jumping around? Why would cash be 101 and then all of a sudden we move to accounts receivable being 106? What about 102, 103, 104? Well, we leave room between the accounts for expansion. So let's say that right now we're a small business and we have one checking account. We call that cash. But let's say that we start making a lot of money and we have excess cash. So we're going to open up a savings account. So we might use account number 102 for cash savings, right? And let's say that we get so big that we need to start hiring people. So we want to run our payroll through a payroll checking account. We may put that as 103, payroll checking. Did you know that's very common, that you would run your payroll through a separate checking account? And let me tell you why. You know, when you run the payroll, you know how much you're going to pay the employees, and you transfer your amount from the regular checking account to your payroll checking, and then you draw the payroll checks, out of your payroll checking. And what's nice about it, when that payroll checking account gets to zero, you know that all your employees cash their checks. And if you have a balance in there, then you can say, well, wait a minute, who didn't cash their check? It's a good control feature. If you kind of commingled your payroll checks with your general checking account, you would lose control of that. So anyway, the point is that you need to leave a little room for expansion as you get bigger. Okay, that kind of explains what an account is and the general ledger and the chart of accounts. I'm looking forward to the next video, which I'll be teaching you about the debit and credit rules and explain the double entry accounting method. Okay, until then, we'll see you later.